I am excited to welcome everyone to our webinar. I'm Eric Walters, founder and managing partner at Summit Hill Wealth Management. I'm thrilled to cover real estate today with my friend Matt Call. Before we jump into it, I wanted to just give you some housekeeping and just let you know that we're going to be muting all lines just to avoid background noise. And we're also going to just minimize video to avoid any distractions. Everyone should have the ability to type in a question at the bottom. So if you have a question, please go ahead and hit chat and share that. And then also at the end of our discussion, we're happy to open up lines and give you a chance to ask Matt questions. So like I said, I'm thrilled to talk with my friend, Matt Call. I've been honored to work with him in our work as board members at Armaday Academy. I have the utmost respect for Matt and his success and professional opinion and personal integrity. And let me tell you a little bit about him. Matt is the principal and founder of NavPoint Real Estate. They have completed over 1 billion of transactions since Matt founded the firm. That's B with a billion. That's pretty amazing. Matt has extensive experience in many investment property types, including retail, office, industrial, multifamily, land, golf course assets. And Matt currently directs the sales and leasing of over 2 million square feet of commercial real estate at NavPoint. And what you may not know about Matt is that he's a fourth generation Colorado native. He's an amazing golfer. He attended University of Colorado Boulder on a golf scholarship. He is a two-time Colorado State amateur golf champion, and he's probably the only person I know who has played in 2 major golf championships. So thrilled to have Matt with us. So Matt, thank you for your time.
You bet. You bet. Thanks, Eric. I will say that, that all the golf stuff sounds impressive, but really golf is a what have you done for me lately game. And so that was another life ago, my friend.
Oh, I don't know. I've heard about your scores on the golf course, so I think you're still killing it. All right, so let's
thanks for having me.
Yeah, absolutely. So let's jump in and start picking your brain. So first, just give us kind of across the the overview of changes you're seeing in the commercial real estate market right now, and I'd be curious to hear the perspective from landlords and also from tenants. What kind of changes do you see?
Yeah, it's really interesting, and it's so I think it's so product type specific right now, and we can dive into those details a little later. But whether you're a retail tenant operating a restaurant or an industrial tenant, and you've got some assembly or manufacturing operation, or you're an insurance agency that occupies office space in a mid-rise building in some suburban market in Colorado. You've been impacted differently, and the same could be said for the landlord that owns and operates that asset. It really depends on the product type and the tenant mix. Certainly, restaurant and retail has been affected more significantly in most cases than have industrial assets or multifamily apartment projects. But it really depends on who you are. So we've had to deal with. Personally had to deal with some, rent deferrals and requests that tenants have made on the retail side in traditional retail product. And then we've also had, office projects where we haven't had, any issues with any of the tenants in terms of them asking for deferrals or rent abatements. So it really depends. It depends on the property type.
Yeah, not surprising, just given where different businesses are and different threats and, kind of challenges. So yeah, not surprising to hear you say that. So you mentioned request for rent reductions or deferments. Could you expand on that a little bit more? Tell us about what you're seeing yourself or hearing in terms of how common are these requests and what's your sense on how landlords are responding to them?
I think the type of request really depends on the tenant, but for the most part, it's been a request for a temporary abatement or, a deferral. I mean, depending on the level of sophistication of the tenant, they're basically just coming to a landlord and saying, hey, I can't pay rent right now. What can we do? And then the onus has been on the landlord to come up with some kind of creative structure, that allows him to keep the tenant in the building. I mean, for the savvy landlords and the landlords that really understand that, hey, you're in a partnership with your tenants, and to play hardball with your tenants right now is not the best strategy. And certainly I've heard stories, unfortunately, none of our clients and none of the assets that we're really involved with have experienced that, where we've had a landlord that's wanted to take a really hard line. But the tenants are just saying, you know what, we've got a government mandated shutdown. We can't open our business, and we can't generate revenue, and in turn we need some help. And so, it's been, as a lot of folks on the call, and as you're probably well aware, Eric, it's really a trickle up effect though. As soon as a tenant asks for a deferral or abatement, the landlord, the owner of the asset, potentially isn't meeting his debt coverage ratio requirements that his lender required when he borrowed on the property. And so he's got to go to his lender, and he's got to ask for help from his lender. And so, the lender's got to be willing to work with the owner of the asset, the landlord. And so it really behooves the landlord to be flexible and work with the tenants that are requesting these deferrals. For the most part, what I've seen is kind of two different scenarios. Either it's a 2-month deferral that just gets added to the back end of the lease. So if it's a 60-month lease and you're a few months in, you're just adding 2 months to the back end of that term. Or more commonly, what we're seeing is, if there's a 2 or 3 month deferral, you're taking that gross dollar amount and you're amortizing it over some period once rent resumes. So we'll say a 12 or 24 month amortization of that 3-month deferral is fairly common as well. So, that allows the tenant to get some relief. What's interesting is we've seen this dynamic, though, for those familiar with the PPP loans, where the tenant has asked for the deferral, then the PPP program came out, and they came back to the landlord and said, hey, just kidding, I really need to pay my rent because it's going to be forgiven in my PPP loan, and I'm not going to be able to spend it otherwise. So, the reality is, in most cases, if a tenant needs help, the landlord's been willing to work with them, in my experience.
And you mentioned that trickle up effect. That was a great phrase. And how do you think the lenders have been responding to landlords that are coming to them and saying, hey, here's what's happening with my, group of tenants. Here's, how the asset is performing. Do you have any feedback or any anecdotes about lenders and their response?
Yeah, I mean, specifically on some assets that I'm involved in partnerships, we've gone to our lenders and asked for some help, ask for basically a holiday, a principal payment holiday. We continue to pay interest on the loan, but a principal payment holiday to lower those monthly loan payments on a commensurate basis with, whatever rent we might not be collecting for that period of time. So I think lenders have also realized that they're in a partnership with their borrowers. And so, when everybody takes the mindset of a partnership and realize this is this wasn't some mismanagement, mistake that the landlord made. It wasn't an operational mistake the tenant made. I mean, this obviously hit everyone on the side of the head like a 2x4, and we all have to deal with it. And so, there's been huge flexibility from lenders. I mean, given the frothy market that we were in, and seeing lenders being so flexible and willing to work has really been encouraging.
Yeah, that's what I've heard from my clients and contacts as well. The landlords, I find, are asking tenants for financials to weed out those that may be just asking for a freebie versus those who are having a true need. And I've heard the same thing, that lenders are looking to be pretty flexible. And I've heard a few anecdotes of landlords being like you said, playing hardball. And I'm really surprised by that, because in this environment, unless you've got a tenant waiting in the wings, and I don't know many landlords that would, you're probably looking at some empty space for quite a while. Is that your calculus as well?
No doubt.
Why push someone else?
Yeah, no doubt about it. I mean, if you've got a restaurant space, or, even an office tenant right now, I think those two categories, the leasing activity is not robust right now. I mean, there's not a lot of folks out there looking to lease large blocks of office space or backfill restaurant space. And so the idea that you're going to really toe a hard line with your tenants if you're a landlord in the midst of this doesn't make a lot of long-term sense. I mean, you're much better off taking a hit on rent on a short-term basis to ensure that you've got occupancy in your building.
Yeah, absolutely. And so let's switch and look at a perspective of a tenant, maybe a business owner or executive that's running a business. We've heard a lot about working from home and how this may become a more permanent feature. And I think some business owners may not hire back 100% of their workforce if they only have 80% of demand. And so you've got maybe two trends happening, where maybe there's a smaller workforce going forward, and then some of those maybe working from home. What's your advice to business owners or business leaders if they're looking at downsizing the footprint of their current space, how can they have a good conversation, with a landlord about that? I'm sure it would kind of make the landlord, panic a little bit, like, hey, we want to reduce our space by 20%. And they might say, hey, we've got a contract. But, how can that conversation go well if a business leader is looking at, more empty space?
Yeah, I mean, that's a tough one, because if you're a landlord and you've got a lease agreement in place, I mean, there's typically you're going to have sublease language in a lease agreement like that, where as a business owner and operator and a tenant in that space, you've got the ability to sublease a portion of that space. So most landlords, I would imagine right now, are not going to be real apt to be flexible about saying, hey, you can take your 10,000 square foot space and reduce it to 7,000. I'll take back my 3,000 square feet of space you're not using. I mean, if you've got a lease expiration that's in the very near term, certainly that's going to be easier to deal with that way and negotiate with your landlord on a lease renewal on less space. But if you've got a bunch of term in front of you on your lease, to downsize right now is going to be a huge challenge.
Yeah, that makes sense.
Just because landlords are feeling the squeeze, right? I mean, I think one of the things that tenants need to consider too is the more tenants that are coming to a landlord for rent abatement, deferral, concessions of any kind, the harder it is to make all of those. And so I think a tenant has to be honest with themselves about how their business is doing, in terms of putting themselves in the best position to negotiate a lease, when the expiration comes, by not asking for too much now. Because landlords are feeling the pressure. I mean, landlords are really feeling the pressure. We know tenants are feeling the pressure. It's funny though, the media, there was a bill in California that was contemplating really the state of California stepping into a private contract between parties and almost being able to terminate lease agreements, allowing tenants to terminate lease agreements, which is just a crazy concept. And landlords are feeling enough pressure that I think they've been demonized to some degree in the media in this whole scenario, and they've got payments to make as well. And so I think you really have to look at it as a partnership, both from a tenant and a landlord perspective.
Yeah, and thinking about that partnership, do you have any thoughts or advice for tenants as they plan to go back to work and try to work out this thorny issue of how do you keep your people safe in your workplace? And of course, it's going to be different from an office to an industrial facility to a restaurant. But have you had any anecdotes about requests from tenants for kind of help in terms of that safety or social distancing? I've heard anecdotes about changes to how many people fit in an elevator, starting to use the stairs, maybe some tenant improvements on kind of plexiglass, or some kind of minor structural changes around an office where they're getting help moving cubicles farther away. And I think landlords are responding and saying, yeah, we certainly want to help from a building standpoint, and maybe on a tenant by tenant basis, we'll, kind of work with you, maybe some changes to the facility itself, within your space. But do you have any thoughts about, tenants and just trying to deal with the issue of workplace safety and going back to work?
Yeah, I mean, I think it really boils down to, based on all the conversations I've had with tenants and landlords, it really boils down to space, right? It really boils down to, for folks that are really concerned with proximity and safety in terms of distancing, it creates an interesting scenario where we're coming out of this era where open office and less square footage per employee has really been the way that folks have leased office space, especially in the urban core. More employees, less space. People are working tighter, open office. No cubicles, really not even partitions. And I think what we're going to see is that 10,000 square foot tenant, that had 100 square feet per employee or 150 square feet per employee, is all of a sudden going to have to probably double that. And so they're going to have fewer employees in that space, which is going to mitigate some of the offset in terms of maybe folks working from home. But I think relative to your question about safety, I think tenants are going to have to work with landlords, and depending on the type of building you're talking about, the landlords and the management companies are going to play a role, in creating some policies to, we're already seeing it. We're already seeing, signage on buildings, limiting the number of folks in elevators. The amount of hand sanitizer and wipes that you see everywhere is off the charts. So, some of it's just kind of new territory, and we're navigating it as we go, obviously.
Yeah. One story I've heard is, some landlords and some tenants are installing always on 24/7 disinfecting spray machines that can use things like hydrogen peroxide and basically put hydrogen peroxide in the air and, kind of sanitize an office with a mobile machine, or they're attaching it to the HVAC and basically saying, hey, we're doing our best to literally sanitize every single surface 24/7. And for them, I've heard it's kind of a competitive advantage to tell their tenants or their customers coming in, hey, we've got this technology in place. I saw it at my dentist's office. I saw it at a doctor's office recently. I heard a friend that owns a CPA firm. He's looking at kind of doing a whole building, sanitation, basically device for that same reason. It sounds like that same, kind of thought process is what you're hearing.
Absolutely. Yep.
Yeah.
Yep.
Yeah.
Seeing a lot of it.
Now, what about demand for office space? I imagine it's down quite a lot, but if, maybe you've got a business that's looking for space, is this a good time to look, or would you think about waiting? Maybe there's kind of a history would say there's price declines in the future, kind of hold tight. You don't have to jump just yet. What would be your advice for someone looking to relocate? Is now a good time to look at it, or is there potentially better deals ahead?
Well, in terms of leasing space as a tenant, I mean, I think now is a great time. I think landlords are seeing so little activity that the idea that they could make a deal now will create a scenario where the tenants are really in the driver's seat in terms of concessions. But I'm definitely of the mindset as it relates to commercial real estate that there's going to be more carnage ahead. I don't think we've really felt the impact of what's gone on, and I don't think we're going to see it until the end of this year. I think the fourth quarter is when the rubber's going to meet the road for all of these. All of these restaurants that are at 50% capacity, and they really know that they can't make the numbers work at 50%, and unless they can get to 100% in the very near term, they're going to cease to exist. And as soon as they cease to exist, you have vacant restaurant space, which is going to be a challenge to release for landlords that own that type of space. And then on the office side, I mean, I just heard on CNBC this morning that BTIG, a big private equity firm in New York, has confirmed that they're not going to come back into any of their U.S. offices until the beginning of 2021. And so I think a lot of the urban office occupiers are going to take a similar approach. Which is interesting because it's kind of a twofold issue. It's going to create a lot of pressure on landlords who now have, potential vacancy coming. And you have two types of vacancy in commercial real estate. And you really see it in office. You have actual vacancy and you have shadow vacancy. And what we're about to see is a gigantic amount of shadow vacancy. And shadow vacancy is where, let's say you've got 100,000 square feet of space that's leased, but really the tenants are only using about 60% of it. And so that 100% is 100% lease. So if that's your data set, then you have 0% vacancy. But if you look at the fact that you've got 40,000 square feet that's not being utilized by those tenants, you really have 40% vacancy. And I'm not saying the numbers are that large, but the numbers are very large. And there's a lot of shadow vacancy out there that's going to start to come home to roost, so to speak, I think 6 months down the road as leases expire.
It's a great point. It would also coincide with the PPP loans. And, as you mentioned, they've kind of boosted, a number of businesses, and, it's a good thing they have. But when those PPP loans expire, when they've been used as they should, of course, the timeline's been extended through the end of the year. But the question is, what happens when that money's gone? And there may be a chance for another round of stimulus, but if not, there is kind of a time of, accounting there. If you don't have that loan, if you don't have that lifeline, like you mentioned, if you're the restaurant, that makes sense. At that time, you would see a lot of hard decisions being made.
Yeah. So in terms of negotiating a lease right now, I think now is a great time. I mean, I never like to try to time the commercial real estate market because it's like catching a falling knife, right? I mean, you don't want to mess with that. So now is a great time to negotiate a lease if you're a tenant, but could it be better in 6 months? Absolutely.
Yeah. So maybe you could dive into that a little bit more. As you mentioned, commercial real estate is a diverse space. What's your outlook for some of the main sectors in terms of what may happen with lease rates or, just the kind of cost and prices for properties? I'm curious to see, maybe if you look backwards, what's happened, and then what would you see kind of in those major categories?
Sure. Well, I think what's interesting to kind of underscore the point that I don't think we've really felt the impact of COVID yet on the way that lease rates and vacancy have been affected. I'll just give you a few stats on the leasing side. with the Denver market as an example. So average asking lease rates in the Denver market for office space year over year through today, so July 10 of 19 compared to July 10 this year, office asking lease rates are actually up 1.2%. Industrial flex lease rates are basically flat. Retail lease rates are up about 1.5%. And multifamily apartment asking rents are just dead flat. So again, I don't think we've seen an impact there just yet. I think it's coming. You haven't had a huge amount of fallout yet from what's happened, but again, I think it's on the horizon. And then in terms of vacancy rates on office space year over year are up about 1.1%. And industrial flex vacancy rates are up 0.4%. Retail vacancy rates are up about 0.6%. And multifamily vacancy rates are up about 0.3%. So again, and I will say that real estate is so localized, and I've talked to a lot of clients, and we're doing some deals in Kansas City and Phoenix and Omaha. It's good to be in Denver. So let's not kid ourselves. I mean, this market has always performed really over the last decade much better than a lot of kind of Midwestern markets. And I think that's indicative of what we're seeing in some of the data right now. The scary thing, I will say, is some of the stats I'm about to give you on just transaction volume. If we look at the investor appetite for income producing assets in Colorado, we've seen a lot of money pour in from the coasts where folks can make some kind of arbitrage between the assets they're selling. Maybe they're selling an apartment building in San Francisco or in Boston or in Miami, and they want to trade into an asset with a higher cap rate in Denver. We've seen a ton of that, that kind of money pour into Denver and Colorado over the last decade. But year over year, investment volume by product type, this is where we've seen a massive decline. So on the office side, we're down 48% year over year in terms of investment volume. Industrial and flex are kind of the two bright spots. Industrial assets are really really what everyone's chasing right now, and that volume is only down 7% year over year. Retail is down 34% year over year transaction volume. Flex assets, which would be kind of single story with some loading, maybe lab space, maybe some light assembly, not huge clear height, those types of assets, that's up 27% year over year. And then multifamily volume is down 23% year over year. So
that is fascinating.
Yeah.
So you've seen a huge drop in transactions, but vacancy and lease rates have not yet come down. So if you had to look into the future, what would you say, maybe based on prior economic recessions or prior lack of demand or lower transactions, do you have any kind of ranges that you would put on this and say, well, if I had to take a guess?
We're going to see a huge increase in volume. I think you have a gigantic amount of capital waiting on the sidelines for deals. I just read an article yesterday. So private equity has raised maybe more money than they've ever raised in a 6-month period for real estate syndications. And so you've got a lot of money sitting on the sidelines waiting for deals. And I think there's a lot of disciplined, patient money waiting for the carnage.
Wow. That's interesting. And so do you think that those investors will just wait until properties come into the valuations that they are looking for? In real estate terms, it's the cap rate. And in layman's terms, it's kind of like the yield on a portfolio. And maybe a really nice, Class A property was only kind of net yielding, 4, maybe 5%. And do you think those institutional investors just wait until that yield gets up to their target return? Maybe it's 7-8%. I don't know. Do you think they're just going to wait and just say, okay, it could fall further, but we like what we're seeing now, even with, kind of negative or conservative assumptions?
I do. I think they're being patient. And what's interesting is I'll give you the cap rate data year over year, because what we've seen this massive fall in transaction volume, but we've also seen a little bit of compression in cap rates based on the lower volume because the assets that are trading are much higher quality. And so what that's done, got less volume. So a lot of the junk, so to speak, is not out there, is not being transacted. And so, on the office side, average cap rates a year ago were 7.2%, right now 6.8%. Industrial 7%, now 7.2%. There's more transaction volume in industrial. So you're still seeing some of the stuff that's, in the tertiary markets, less quality asset trading at a higher cap rate. So that drove that, those cap rates up. Retail was 6.5% a year ago, 6.3% now. On the flex side, 6.9%, and now 7% cap rate. So, 10 basis points there. And then multifamily cap rates are flat at 5.9% year over year. So really interesting. I think what we're going to see is you see that drop in rates slightly and cap rates slightly, and now we're going to see things start to move potentially as some of the distressed stuff, comes on the market late in the year. So, but who knows? I mean, this is obviously, in terms of how a pandemic affects commercial real estate, this is new territory for everybody that's functioning in this environment now. So
yeah. And you mentioned before, deals in Phoenix and Kansas City. Do you have any impression or data that compares how Denver's doing relative to the rest of the country? I mean, the data for us as an economy, as a city, has been fantastic, as you mentioned, at least for the last decade. But any anecdotal data on how other major cities are faring compared to that?
Yeah, I mean, if I were to just give you anecdotes, I would say leasing activity in Kansas City is much lighter. There are fewer tenants. It's much harder to get a lease transaction done as a landlord right now. Cap rates are higher. They're absolutely higher. There are fewer investors looking at deals in Kansas City. You go to Phoenix again, I think you see higher cap rates. I mean, that's a very robust market down there. But cap rates are definitely higher. You can get some more yield in Phoenix than you can in Denver. So I think the underlying economic fundamentals also reflect on the commercial real estate markets, relative to Denver in a lot of those Midwestern cities.
So let's keep thinking about this idea of cap rates, or for the layman, kind of net yield on a property. What's your advice to investors looking at this space right now? Of course, investors kind of determine their own risk tolerance in terms of how much of a distressed property they're willing to go towards, and potentially have a higher yield, but more risk. You've mentioned that higher quality properties are trading right now at probably higher valuations, but you're an investor. What's your advice to other investors in terms of how to look at this market and sift through what opportunities may be there?
Yeah, I think it depends on what your investment goals are. If you're looking for passive income, kind of mailbox money, so to speak, a return that you can count on. We've sold, recently, very recently, in the last month and a half or so, a couple of single tenant net lease assets, which there's still a lot of activity on those types of assets. And that would be typically a retail asset. We recently sold an O'Reilly's Auto Parts with 17 years of lease term left. O'Reilly's is publicly traded, has performed really well through the pandemic because there's a lot of people that are buying parts for their cars and repairing their cars themselves, right? I mean, typically in recessions, the auto parts sector does well because people like to do the DIY thing, just like Home Depot and Lowe's are really crushing it right now. The auto parts stores do the same. So we had multiple offers on the O'Reilly's, and it sold at full asking price, which was about a 5.5% cap rate, in Front Range, Colorado. So those assets are really popular. We sold a Dollar Tree store as well. Again, similar scenario where we were very close to full asking price. I think if you're looking for income that's really going to have, little downside risk, those types of assets make sense. Obviously the yield's lower. I think the other product type the other two product types really that I think are good to focus on in this market would be medical office. Medical office tenants, even if they were shut down for a period of time, they tend to be very good payers. They're what we call sticky tenants. They've spent a lot of money on tenant improvements, so they don't typically go anywhere. They typically renew their leases. They've built a clientele that knows where they are physically and geographically, so it tends to hurt their practice if they move. So medical office makes a lot of sense. And then I think industrial. Industrial is, we've continued to see very strong leasing activity for industrial, both big and small, in the midst of the pandemic. So I think those, if you're looking to invest now, I think those are the property types that probably have the least amount of downside risk. And then on the value add side, again, I think if you're looking for something that's got some upside that maybe, is a little distressed, I think patience is the key right now.
Yeah, right. Yeah, there could be a lot more distressed opportunities coming online.
Yeah.
And are you seeing any differences between the different metro areas? Thinking about, Denver, Commerce City area, there was certainly a lot of news about how much industrial space was being taken up for marijuana production. I heard from a number of clients that they just could not get any reasonable prices in Commerce City. But, you kind of go through the different major areas kind of along the Front Range. Are you seeing any pockets of real concern or opportunity amongst the, kind of Front Range communities, or is it probably pretty similar?
I think it's fairly similar. Obviously, prices in central Denver are always going to be higher. As far as marijuana is concerned, I think that thankfully for non-marijuana folks that need to occupy industrial property, that ship has sailed to a great degree. I think new construction, has really caught up with the amount of space, 5-7 years ago that was absorbed by marijuana type uses. I mean, those uses are still out there, and now you've got hemp and CBD that started to occupy some of that space. But, industrial lease rates and vacancy rates are still very strong for that sector. So, but I think that's a function too of kind of the e-commerce world that we're starting to live in, and it's all honestly been accelerated by this pandemic. So that's why I think industrial is going to continue to be a darling of investors going forward. I think the market that's really been robust and will continue to be is Colorado Springs. I think Colorado Springs has always been kind of the little sister of Denver, but there's more and more investors nationally that are looking at assets, and we've sold a number of assets in income producing assets in Colorado Springs to out of state investors over the last several years, and that continues to pick up momentum.
That's really interesting. Wow. So I just want to pause, if that's all right, and just encourage everyone who is listening. If you have a question, please go ahead and submit it by chat. And then also, if you'd like, go ahead and unmute yourself and go ahead and do that. So while people are thinking about questions, Matt, I'm going to share one that came in ahead of time. This was a question, just your outlook for kind of a business from 6 to 12 months from now who wants to find a new lease or buy building in the office space. You may have kind of covered this already, but what would be your advice to them as they think about it? This could be maybe a smaller footprint, but they're looking for a new lease over 6 to 12 months. Sounds like they have some flexibility in terms of time. What would be your advice? And we'll limit it to the office space.
Yeah, if on the lease side, I would say probably if they're 6 months out, I would say in a couple of months, in 60 days, maybe 90 days, really start the search in earnest. I think that's when you're going to start to see a bit more motivation from landlords. Let's just say that. It's there now, but I think if they've got it, they're really not promoting it. Landlords aren't promoting their desire to do deals, but I think you're going to start to see them being more vocal about their need for tenants, 3 months from now.
Yeah, that makes a lot of sense. So I want to thank Matt for your time and your great insight. This has been just incredibly helpful to get perspective from someone with feet on the ground, both on the brokerage side and the investment and development side. And then let everybody know we are going to share the recording and encourage you to reach out to Matt and his team at NavPoint. If you have any questions, if you want to go deeper, Matt and his team do an amazing job, and encourage you to reach out to them directly.
Thanks, Eric. Appreciate it. Thanks for having me on.
Thank you. And thank you to everyone who joined us. Have a great day.
Take care.